Many of you have been asking me about my opinion on ServiceNow stock, ticker symbol now. The stock is down 20% year to date, absolutely brutal. But the stock is not alone. This market really hates software, and I believe the algorithms are programmed to sell any stock that has to do with software. Even Microsoft is going down. The cybersecurity stocks, which are great companies, they could benefit from AI. They're going down as well. Adobe is down 34%, and even CRM is down 40% over the last year. Now, for ServiceNow, I have a differentiated opinion for most people around ServiceNow. I like the stock, but I still believe it's a little bit expensive, and I'm going to tell you why. Now, earnings per share, they had a great beat. They got 92 cents versus 88 cents expected. They also did a decent beat on revenue, yet the stock went down 11% in one day. And one of the analysts, he said, this is good, but not good enough. In an environment of heightened investor skepticism on incumbent application vendors, stable growth in line with expectations likely falls short of shifting the narrative. So they did meet the expectation, they slightly beat them even, but this is not enough to shift the AI narrative that all the software applications are going to be disrupted by AI, and all those companies are going to vibe code their own software, or you're going to have more competition in general. Now, the company is trying to differentiate itself, and they're becoming what they would call the AI control tower for business reinvention. And they're doing it through acquiring many different companies in key areas, and they're integrating them all within one service. Like they recently acquired a cybersecurity company called Armis for about $7.7 billion. And this is going to help them with the cybersecurity offering, identity security stuff. And they also acquired another company for about $3 billion. The company's RPO, which is mainly their future obligations or their backlog, you could say, it has grown 26.5% to $28 billion. So it's a very healthy backlog, amazing growth in general. Renewal rate is still very healthy at about 98%. No signs of AI disrupting them so far. Now, my main concern with ServiceNow is the valuations. If you look at the valuation of ServiceNow, it's trading at 28 times forward earnings. This is after the sell-off. The stock used to trade at 100 times. Now it's trading at 28 times forward earnings. But this is 28 times non-GAAP forward earnings, which means it doesn't include stock-based compensation. The company has massive stock-based compensation. It's more than their total revenues, total net income, guys. So net income is $1.7 billion. The company's stock-based compensation is $1.9 billion. This is a lot of stock-based compensation. And you could really see the difference if you look at the GAAP versus non-GAAP earnings per share. For example, this 28 times forward earnings multiples that I showed you is based on the non-GAAP earnings per share of 418. Now, if you want to include stock-based compensation because it's an actual expense and you want to use GAAP numbers, which I believe what most people should be using, you would have to use 237. If you take the current price for ServiceNow, which I believe is about 116, you take 116 and you divide it by 237, you get a multiple of about 49 times earnings. So despite the sell-off on ServiceNow of over 50%, the stock is still trading at 49 times GAAP earnings per share, which is really expensive, guys. And even on a non-GAAP basis, it's trading at 28 times, which you could still say it's relatively expensive. Now, the company is a great company. I like the CEO. He's very enthusiastic, and he's doing a buyback program, and he wants to stay within the company, and he bought the stock, and he seems like a good CEO in general. But the valuation was too extreme, and it's hard to make the case that ServiceNow at this price is like a generational buying opportunity. It's a great company, great margins, great subscription-based revenues, but the multiple is still relatively high on ServiceNow. Now, I believe the company here, to be honest, at 28 times forward non-GAAP is really not bad for a company that's expected to grow earnings per share 19% for 2026 and 19% for 2027, 28, 27 times. For such a resilient company, subscription-based, a lot of the governments are their customers, and multinational companies and Fortune 500 companies, and they have some really important customers and a very sticky service, which I don't believe is going to be 100% disrupted by AI. 28 times is really not bad at all, but I don't believe it's like the bargain of the century, or it's like a generational buying opportunity, as I would like to call it. For me to say that the stock is a generational buying opportunity, I would have to kind of buy the stock at a one peg ratio, or one time price to earnings growth. Even on non-GAAP, I'm going to have to buy it at one time. If you look at stocks like Adobe, if you look at stocks like CRM, which maybe are not as great as this one, they're trading at one or below one price to earnings growth, or a peg ratio. If you could buy ServiceNow at one peg, you would really be getting a massive bargain. Now, the stock, again, is expected to grow in earnings per share about 19% over the next 2 years. We could just choose 20% earnings per share growth. Okay, so we take the expected earnings per share for 2026, which is about 416, and this is again non-GAAP. We take 416 and we time it by 20 times, assuming we want to pay one peg for ServiceNow. If we time it by 20 times earnings, we get about $83 per share, or you could say $85. And the stock right now is trading at 116. So I personally believe if you're really dying to own ServiceNow, $116, $110 is really not bad at all. But if you're trying to look for a generational buying opportunity, anything under $90, it starts to get ridiculous for the stock. It starts to get too cheap to ignore. But at this price, I could still make the case for the stock potentially going down another 10, 20, 30%. And you could still, say that the stock is still relatively expensive, to be honest. But the problem with those stocks is it's really hard to know what will the company or what will the market value them at. Will they use GAAP numbers, or will they use non-GAAP numbers? Whenever the stock is going down, everyone uses GAAP numbers. When the stock is going up, everyone uses non-GAAP numbers. And if you look at stocks like Cloudflare and CrowdStrike, they have terrible stock-based compensation, but the stock keeps on going up. So it's really hard to know what the market is trying to use. And I believe ServiceNow here is not bad at all, but it's not the bargain of the century. If I want to call it the bargain of the century, it would have to be at a one peg ratio using one GAAP, or about $83 per share. So this is my opinion on ServiceNow. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.